Klas, thank you so much for joining us here at SuperReturn CFO and COO. It's been an extraordinary 18 months for everyone. What are the biggest challenges that this industry has faced during that period?
I think it's been such a broad-based decline in revenue in many of the sectors, while taking social responsibility on the cost side. I think it's been kind of a big thing. We instituted a COVID task force in January 2020, and it really got going in February as we saw the pandemic spread. And we came up with fairly firm guidelines for portfolio companies in early March. So health and safety first. Secondly, don't profiteer. If you have a product where there's a shortage in the market, you can't profiteer from this. We try to come up with sustainability guidelines for our portfolio companies. So that was, I think, a big challenge, and some of our peers, I think, were tempted and at least temporarily misguided in how they approach these things.
It's interesting to hear you say that. You think it had a real impact in terms of the social responsibility in your portfolio?
It did, right? So first, we had a virus subcommittee with the scientists, with the McKinsey team on that advised us constantly and modeled the viral development. And initially we said to our portfolio companies, we don't know what this virus is and what it does. And until we know, don't take a risk with your staff health, right? So if you need to close the factory, close the factory. We worry about the capital, the profits later. We can't be too late. I mean, we can't wait half a year. We had to be quick on our feet. And then very rapidly, sufficient scientific evidence came out, was captured in our virus subcommittee. And we started getting comfortable that we knew, incubation times, maximum 2 weeks, duration of illness, the R numbers, started seeing lockdowns, how do you handle that? And as we got more comfortable with that, we could then go from being super safe into being more balanced economically versus safety. Because, there's also a health aspect of killing companies, right? People will lose their jobs, like this is a responsibility angle to that as well.
Absolutely. And did you see any change in the actual portfolio construction as well because of the pandemic?
No. Initially, no. Initially, it was all about health and safety. Then we moved into liquidity preservation. Now there's lockdowns. How we modeled actually the viral development, and we forecasted that lockdowns would ease in August to September. So how do we sustain the companies until then? Where do we need to inject liquidity? It turned out that we didn't almost inject any liquidity anywhere, but how do we get government support where programs are available? We had a hot desk. The portfolio company CFOs could dial in to just learn about which programs are available in which countries. How do you cash forecast accurately? We had CFO clinics on cash forecasting. So that was the second. So health and safety, then we got into liquidity preservation. Then we went comfortable around that. Then it was how do we long-term value maximize? But it was a portfolio company by portfolio company thing. And then as we came into the fall, half a year later, then we started thinking about the whole portfolio perspective. So a bit of Maslowian hierarchy there financially.
And you mentioned there the volatility word and valuations. What's the situation with that now, and what have you seen happen over that 18-month period, and where are we at now?
So valuations, we had, I think, an unusual amount of scrutiny on our valuations simply because we were going into fundraising exactly as COVID hit. I think we were the first ever fully virtual fundraise. So we kicked off fundraising in April, 1st of April 2020. So that will inevitably bring scrutiny on your valuations, right? On top of that, the whole LP community was rallying to scrutinize GP valuations because of COVID. There is an inherent temptation, I think, in our industry to smooth the valuation developments. There's a big hit in your public peers. People are looking for reasons why they would not benchmark that quarter or another quarter. We saw some peers bringing out DCFs with very long time horizons. Some people seem to go back and use entry multiples instead of public market multiples because they simply crashed right in March, April of 2020. But we actually didn't do any of that. So we stuck to the EV, EBITDA, LTM multiple benchmarking approach and kind of took it on the chin. It helped that we are in sectors that largely were unaffected or benefited from COVID. Out of 44 portfolio companies, we had 8 that were negatively affected and 12 that actually got a boost from COVID, oddly enough.
It's interesting that was what you already had in your portfolio. Has that changed your plan going forward now, seeing the resilience of those different sectors?
Actually not. I think we were in the right sectors going into COVID, and that's actually by design. We 6-7 years ago had a strategy project where we decided to discontinue some of the sectors that we're working on. So we shifted into a sector first model, not the country first model, and we focused in on 3 core sectors: healthcare, financial services, and tech and pay. And those are sectors that people are now piling into, but we've been there for a very long time. And we have seen no reason to change. I think there's been some changes in the subsectors, like on the very nitty-gritty, granular
level. Yeah. And do you see other, you said there, people jumping on bandwagons, do you see other companies now sort of wanting to try and improve the resilience by that thematic kind of investing?
Yeah, we see that our space is becoming more crowded. I think a lot of sponsors are shifting the portfolio construction and sector selection into sectors where we've been for a long time. The proof will be in the pudding here in the next few years, how well they're faring. I think a lot of the subsectors we're in, they benefit from deep sector expertise, and I think it's difficult for others to come in and they'll have to learn for a while before I think they can do the good investments. So I think we continue to be quite bullish about our opportunities to invest.
This is one of the first events to be back in real life. How is it to be back amongst your peers and to be sharing ideas and reconnecting?
It's brilliant. Yeah. I'm a bit of an extrovert, so it's fun to be out and about. We kicked off business travel 3 weeks ago, properly. We've been very, very selective. We have allowed some business travel for critical purposes, such as meeting a founder or potential seller of a business where you need to build the relationship prior to getting kind of the opportunity to bid. But we've been very, very selective, but we relaxed that a bit, at least after summer here. So,
what's your view on how personal an industry this is and how important that is to this sector?
This is a very personal industry. It's not like the stock market where you pile into a stock without having met anybody, right? This is, so from an LP point of view, we're here at, SuperReturn, but there's also Super Investor going on just over there. And you meet prospective investors, you meet long-standing, loyal investors.
It's good to reconnect.
Yeah, it is. And then on the asset deployment side, it's really, really important. Meeting the management teams, meeting the sellers, meeting the companies.
It's great to have you back. Thank you so much for joining us. Great
Thank
to talk
you for
to you,
inviting
Klas.
me.
Thank you.
Good to be out and about.
Good to talk.